Hello everyone, this is Tejashwini. In today's classes, let's do the revision of the capital gain as a whole. Okay. So first of all, when we are starting with the concept of capital gain, that is, capital gain is nothing but the gain which you're getting out of the capital transfer of a capital asset. We need to understand the base term over here. Transfer of a capital asset leads to capital gain. Okay, we need to understand the main term of what is meant by capital asset and what is meant by the transfer. Remember, capital gain will generally be taxable in the year of transfer, because the year of transfer and the year of receipt can be two different year in case of your capital gain, but we are going to tax it in the year of transfer. This is the base provision. Okay, so the other exception to this case also we are going to see. Right now we are just entering into the revision of the capital gain. Remember, it has to be taxable in the capital asset, that is capital transfer of a capital gain arises with the transfer of a capital asset. Okay, great. So now let's try to understand what is meant by capital asset. See, capital asset means property of any kind, any securities, any shares of securities, or any unit linked insurance plan. But remember, it does not include any stock in trade. Why doesn't why it does not include any stock in trade? People, the stock in trade is going to be considered under PGBP, right? It is going to be considered under PGBP. That is, stock in trade shall be taxable in PGBP, not in capital gain. Hence, it is excluded from the transfer of capital asset. Remember, in order for your capital, your gain to be taxable under the head capital gain, then it has to be a transfer of a capital asset. If it's not a capital asset, you can't put the capital gain. That is, you can't tax it under the head capital gain. If it is not a transfer, even then, in that case, you can't put it under your capital, that is, you can't tax it under your capital gain. Remember, it has to be capital asset and it has to be a transfer. Both conditions need to be satisfied in order to say, yes, it is taxable under capital. Now, remember, any personal effects of mobile property, any personal effects of mobile property. See, first of all, it includes property whether connected to the business or profession, personal, business, mobile, immobile, everything is included under the base definition. And now we are going to exclude the personal mobile property, that is furniture, car, etc. are being excluded. But this is an exclusion for this excluded part, which is nothing but your exclusions for the personal effects means these following whatever you have seen will be considered as your capital asset. That is jewelry, archaeological collections, drawings, paintings, sculpture, work of art. These comes under the definitions of capital asset, remember. Okay. Specified gold bonds, special bearer bonds, and gold deposit bonds, sovereign gold bonds, all these doesn't come under the definition of capital asset. People, remember, the intention behind the government over here is very simple. That is, intention behind the department act over here is going to be, they have included, even though jewelry is a personal mobile property, they've included it under the definition of your capital asset. Because once it is included under the definition, it becomes capital asset, it becomes taxable. If it is not included in the definition of capital asset, then it is not going to be taxable. See, jewelry is something which you're buying for your purpose, and these bonds are something wherein these bonds are usually issued by the government. You invest your money in these bonds, you're going to get at the time of redemption, you're going to get the gold equivalent, that is gold price, whatever is there, equivalent money you're going to get in this case of bonds. Simple. So now whatever the bonds which you're going to consider over here, these are not capital asset, that is on the redemption. Suppose now the gold price is 7,000 rupees. The time of redemption after 5 years, 8 years, whatever the time, let's consider the gold price is 15,000. Whatever the money 15,000 you're going to get at that point of time of redemption, that will be tax free because it is not a capital asset at all. But in case, suppose you have purchased jewelry now, and when the gold price reaches 15,000 rupees, you are selling that gold. In that case, it is going to be considered as capital asset. It will be subject to capital gain. Clear? Now, in this case of this is the reason why the government have, that the department have bought in these gold bonds over here as not a capital asset, so that you switch your thought from investing in jewelry to the bonds for that matter. Clear? Next is going to be rural agricultural land in India. Remember, people, rural agricultural land is excluded from the definition of capital asset. What about urban agricultural land? Urban agricultural land is included in the definition of capital asset. Please remember. Okay, this is the radius in which you are going to consider whether it is a agricultural land or urban agricultural land or rural agricultural land for that matter. The next important definition goes with the short term or the long term capital asset. Okay. If I'm speaking about the capital gain, short term capital gain, long term capital gain over here, short term and long term capital gain is dependent on the short term or long term capital asset. If it is a long term capital asset, the gain derived from that is going to be a long term capital gain. If it is a short term capital asset, the gain which is derived out of it is considered as the short term capital gain. Simple. Now, remember, for the listed shares, listed units of mutual funds, listed zero coupon, that is zero coupon bonds. If you are holding it for a period less than or equal to 12 months, it is going to be considered as a short-term capital asset. Gain from that will be short-term capital gain. If it is held for a period greater than 12 months, long-term capital asset. Remember, exactly 12 months, you will call it as short-term. Unlisted shares, not unlisted units of mutual fund, only unlisted shares, land or building, if you are holding it for a period less than or equal to 24 months short term, more than 24 months long term. Unlisted securities other than shares, that is other than shares, unlisted securities and other capital asset like jewelry, archaeological collections, whatever is the capital asset, excluding these will be coming under the third category. If it is a short-term capital asset, it is held for a period less than or equal to 36 months. Long-term capital asset, if it is held for a period more than 36 months. Okay, this is the point. Next important definition comes for the transfer, that is coming under 2 subsection 47. That is the sale, exchange, relinquishment, extinguishment of any right, compulsory acquisition, owner of capital asset, that is conversion of capital asset into stock in trade, maturity of the redemption. All these points comes under the definition of transfer. Remember, when you're selling, exchanging, you are telling that, hey, I don't want the property right only, relinquishment, extinguishment, compulsory acquisition from the government, conversion of your capital asset into stock in trade. All this comes under the definition of transfer. Only if it comes under the definition of transfer, it is going to be considered as your capital gain. Capital asset transfer took place in the year of transfer, that is in the year of transfer. Generally, capital gain is taxable. There are certain exceptions. We are going to see that. Format of capital gain. Remember, people, when it comes to this format, whatever it is, I hope this video is been recorded with an intention where you've already read your classes once. That is the intention. That's why it is just going to be your revision videos of your capital gain. Okay. Now, if you want the notes is there in the Telegram channel. Link is provided in the description. You can go and join. Short-term capital gain and long-term capital gain. Remember, people, the format goes like this. First of all, you're going to record your sale consideration over here. Then you're going to record whatever the expenditure. And then you're going to get net sale consideration. Everyone, then you're going to get your net sale consideration. Then you're going to subtract your cost of acquisition. You're going to subtract your cost of acquisition. Then you're going to subtract your cost of improvement. Then you're going to get your short-term capital gain over here. Remember, in short-term capital gain, always remember, there's no concept of indexation for your short-term capital asset. Short-term capital gain, whenever you're calculating, there is nothing that you can provide for you to provide indexation. Indexation you can't take. Simple. Indexation can't be taken for your short-term capital gain calculation. Indexation can be taken only for your long-term. Okay. Then you're going to get exemptions, if any. Then you're going to get your short-term capital gain. Okay. Similarly, in the case of your long term, you're going to have sale consideration, you're going to have expenditure, then you're going to have net sale consideration, then you're going to have take your indexed cost of acquisition, then indexed cost of improvement, everything. Then you're going to take long term capital gain before exemption. Then you're going to get exemption under section 54. Then you're going to get long term capital gain. Every simple. Now let's try to understand about the indexation benefit. Before the indexation, we'll try to, before indexation, we'll try to understand what we are going to see. Remember, when it comes to indexation, how the indexation has been affected or how the indexation is been considered is that cost of acquisition. That is, what is your cost, people? Cost means something which is moving out of your pocket. If you're paying out of your pocket, if you're paying out of your bank account, that is actually considered as your cost, base definition. Here now what happens? The department now gives a benefit of something called as indexation for you. Let's try to understand how this indexation is affected. Okay. Let's consider in the case of indexation, people. In the case of indexation, what happens is that very simple. Let's try to understand. Indexation means you are valuing the money or the time, the whatever the time value of money is being considered in the concept of indexation. Let's try to understand. The value of 1 rupee today is going to be somewhere around 0.909. That is, at the end of 1 year, you are going to consider the value of 1 rupee as 90 paisa. How would you calculate this? How would you calculate this 90 paisa over year would be? You guys remember in your financial management, you used to do 1 divided by 1.1. That is 0.1 is going to be 1 plus R you are going to consider, right? 1 plus R. What is 1 plus R? 1 plus rate of the rate of whatever the discounting factor that you are going to add. Okay. If you do this, you are going to get 0.909. If you do that in your calculator twice, equals to twice, you are going to get 0.867 something. Just an approximate number. It's not an actual number. Just an approximate number. Let's do it in an actual basis also. Yeah. It is going to be 0.826. Okay. Similarly, if you're going to do it for the third year, if you just give equals to, it will be 0.7513. Okay. What does it mean? The value of 1 rupee today is going to be 0.90 paisa at the end of 1 year. It is value of 1 rupee today. It's going to be 82 paisa at the end of your second year. The value of 1 rupee is going to be 75 paisa at the end of your third year. That is what it is going to be. Clear? It means the value of 1 rupee is going to decrease day by day, day by day. In the same way, if you're going to, if you would have, suppose instead of keeping the money in your hand and decreasing the value of your money, that is value of your whatever the money which you have kept in hand, now you have invested. Okay. Suppose if you have invested, the value of 1 rupee would now be multiplied into 1.1. Next, it would be multiplied into 1.1. That is 1.1 multiplied by, that is multiplication. If you take it annuity basis, your value of 1 rupee keeps on getting increased day by day. That is the power of compounding. Correct? So, can I say whatever the money which you have over here, it is dependent on the concept of the future. That is the aspect of money being increased. Then the money value keeps on getting increased. So can I say the value of 100 rupees at the time of 2001 and 2 is going to be, if you have invested 100 rupees in somewhere. Okay, suppose let's consider if you have 100 rupees invested in some point. Considering the inflation factor into picture and your cost being 100 rupees, your 100 rupees being invested, that is being your cost. Anyway, keeping the indexation in the point, sorry, keeping the inflation in the point, your value of 100 rupees would be 348 rupees in PY 23-24 is the point. In PY 23-24, your value of 100 rupees which you have invested in 2001 and 2, in PY 23-24, it is going to be 348. That is what it means. Clear? So, what the department told is very simple. Array, you are such a good fellow for life. Everyone. You're such a good fellow for life. You have invested in 2001 into 100 rupees. So what we will do, let's consider the cost of acquisition that you had in the year, that is in 2001 and 2. You have invested in a land. Okay, 10 lakh rupees is what you have invested at this point of time. Everyone, you have invested 10 lakh rupees at this point of time. Let's do one thing. Whatever 10 lakh rupees you have invested, that 10 lakh rupees will make that as an equivalent factor. Okay. Let's try to understand in this way. If 10 lakh rupees has been invested when your cost inflation index was 100, what would be the cost? What would be the amount of the 10 lakh equivalent to if this CII in this PY is going to be 348? Every, what does it mean? The cost of 10 lakh rupees which you have incurred in PY 2001 and 2, if you have invested 10 lakh rupees in your PY 2001 and 2, cost being 100 rupees as equivalent. If you've invested that same equivalent money in 348, that is in the same equivalent money in PY 23-24, how much you would have invested? How much would have been your cost? We are going to bring it to your equivalent position. Okay. So how you are going to bring it to an equivalent position? You are going to do just do the cross multiplication. That is 10 lakh divided by 348 multiplied by, sorry, this 10 lakh divided by 100 multiplied by 348. That is what cross multiplication is what I'm doing. Okay, if you do the cross multiplication, please do it from your end also. 10 lakh divided by 100 into 348. If you do, how much would you get? 34 lakh 80,000 rupees is the money that you would invest today, keeping the equivalent position of 2001 into money. That money of 10 lakh rupees would be valued at 34 lakh 80,000 rupees today. That would have been your cost. Clear? Why the department is allowing you this indexation, this calculation, whatever you have done is nothing but your indexation. Why the department is allowing the indexation is that, array people, the sale consideration or the full value of consideration, whatever you are considering, this is going to be based on the consideration that you have determined in the year of transfer. That is, suppose for me, PY 23-24. This is the year of transfer, right? This is the year which I'm going to consider that is important for me. I'm going to consider PY 23-24 as important. That the money which is received is going to be taxed over here. It means whatever the cost, whatever the cost which I'm going to incur, I will make that cost equivalent to today, so that you will actually get certain benefit and we will promote you so that you will be very motivated to invest in the capital asset for that matter. If you invest in capital asset, people investing in land or building boost the real estate sector, correct? And the government also wants that to happen. So they are like, okay, we'll do one thing. We will give you indexation benefit if you're investing in the capital asset for a long term. You also take the benefit. I'll also take the benefit. Simple. Great. That is how indexation is about. See, if you have understood this point, whatever we are going to consider over here, same thing is being done in the form of formula. Say 10 lakh rupees was your cost of acquisition. 100 was the CII of the year of purchase. If you remember, year of purchase is 2001 and 2. CII of the year of purchase, that is when the asset was first held, nothing but purchase, or 2001 and 2, whichever is later. I'll come back to this point. Okay. 348 is the CI of the year of transfer. Clear? Now, what does it mean? The year of purchase in my case was same, so I've considered. If the year of purchase, suppose if I purchased in 2004 and 5, this would have been 113 or 100, whichever is later. Which year is later? Yeah, 2001 and 2, 2004 and 5. Which one is the latest one? 2004 and 5 is the latest one, no? So you are going to consider 2004 and 5 is the latest one. You are going to consider the C. Clear? Suppose you had purchased your property 95-96. Clear? Purchase property 95-96 only. So now tell me whichever is later over here. 95-96, 2001 and 2. Whichever is later. Which one is the latest one? 2001 and 2. People, there is no CII available prior to 2001 and 2. So if you want to take as a base, you have to take that CII of 100 only. It should start from 100. That is what it means. Clear? Now, remember, what need to be remembered is that CII of 2001 and 2, please remember. Other things will be given in your exam 2023-24, please remember 340. Okay. So now we have understood the concept of indexation. We all know how more the cost you have. Suppose in this place, instead of 10 lakh, if it was 20 lakh, this whatever the amount which you would have got might be doubled. Why? Higher the cost, higher the indexation benefit you would get. Clear? So now let's try to understand how to compute the cost of acquisition. That Regarding to this point of cost of acquisition of certain assets over year, people, first comes the concept of goodwill. All of us know goodwill have two types of goodwill. That is, one is self-generated goodwill. Goodwill comes with two types. Goodwill is one is self-generated goodwill, and another one is your purchased goodwill. Remember, people, goodwill is something intangible in nature, and if you are able to give that into your point, if you are able to give that goodwill, that is, if you are able to find the cost over there, then it is going to be considered. All of us know for self-generated goodwill, we are not having any cost of acquisition for that matter. Everyone, cost of acquisition in case of self-generated goodwill is nil. You please try to understand self-generated goodwill. Cost of acquisition is nil. This is going to be a revision class, and the explanation as such why it is going to be nil, everything will be done in the regular class. Okay, let's stick to a revision now. Self-generated goodwill, remember, cost of acquisition is going to be nil, and in case of your purchased price, in case of your purchased goodwill, remember, whatever is the purchase price of the goodwill minus whatever the depreciation that you have charged prior to PY 2019-20. That is up to 1920, you have charged depreciation. That is after 1/4/2020, on or after that, you have stopped charging depreciation. That is because of the amendment which you got in your act, that the depreciation need to be stopped for the goodwill. That is the reason why the depreciation was stopped till that point of time, whatever the purchase price. Suppose purchase price was 20 lakh and depreciation charged up to 1920 was 4 lakh. 16 lakh would be the amount. 16 lakh would be considered as your cost of acquisition. Whatever after giving the depreciation you would consider. Clear? Done? So this is going to be your one. Remember, for the financial asset, you need to understand something. In order to understand the bonus shares and in order to understand about the ratios, you need to understand about the financial asset which is coming under section 112. Okay. See, in case of financial asset under section 112, first of all, you are going to charge the sale consideration as usual. You have no problem for life. Okay. Sale consideration you are going to consider. Clear. And then you're going to give the fraction of the expenses. We've already seen that whatever expenses you have paid in order for you to get your financial asset, it is going to be taken as your subtraction. Then you are going to get net sale consideration. Remember, in case of cost of acquisition, whatever you're considering over here, it is going to be higher of the actual cost or the lower of the following. Okay, very, very important point, people. Identifying the cost of acquisition for your 112. This I'm specifically speaking about 112. Then we will see the remaining point later. Okay. Your actual cost of acquisition, your actual cost of acquisition or lower of the following, it is going to be FMV as on 31/1/2018 or the sale consideration, whichever is lower. Everyone, cost of acquisition is going to be higher of the following, that is actual cost of acquisition, or lower of the following, fair market value as on 31/1/2018, sale consideration, whichever is lower would be considered as your cost of acquisition. Let's try to understand why. Okay. See, people, with regarding to this cost of acquisition, whatever you're going to consider, cost of acquisition means what? Whatever you have moved out of your pocket, let's consider it as 5 lakh. Okay. Lower of the following shall be fair market value as on 31/1/2018 or the sale consideration, whichever is lower is what you would consider. Why is this provision being brought into place is the first question that you would get. See, provision is was brought into picture because of certain reason. See, fair market value as on 31/1/2018, remember, there was something called as long-term capital gain being exempted prior to this. Okay, when the budget was announced on 1/1/2018, prior to the announcement of budget, that is on or before 31/1/2018, your long-term capital gain from shares was fully exempted. Everyone was fully exempted. Even though you got 10 crore rupees also was exempted. Now, on or after that is after the budget announcement date, they made it as taxable. Exemption was removed, so it is now it became taxable. People started crying. Arey, what? Before it was exempted. If I knew it before, I would have sold. I would have got my entire capital gain exempted. Now, whatever is happening, it's going to result in a problem. I have to pay the long-term capital gain tax. People started panicking. So now, what the department told is that, "Arey, don't worry. We are not going to make your long-term capital gain to the extent of whatever was accrued till this point of time as taxable." That is, suppose fair market value, suppose let's consider if you would have sold your long term, that is shares, which is as on fair market, that is as on 31/1/2018, if you would have sold it at a price of 8 lakh, that is fair market value was 8 lakh, and you have sold that shares at 8 lakh. Suppose now, if you would have sold it, you would have sold it at 8 lakh. No, take that value into your cost of acquisition. Now, what is your cost of sale consideration in my example? Your sale consideration is 6 lakh. It means up to 8 lakh rupees, whatever is the fair market value as on 31/1/2018, we are not going to charge it for tax at all. It will not come under your capital gain. How we will see? Okay. Fair. Now, in my example, let's consider my sale consideration is 16 lakh. Example only. My cost, the cost involved is 5 lakh. Fair market value, suppose I have sold on 31/1/2018, I would have sold 8 lakh. Sale consideration being so. Now I will consider lower of the following. That is, lower of the following is going to be how much? 8 lakh over here. I am going to consider 8 lakh as my point in my, that is the answer which is getting selected from the lower of 2 points. Cost of acquisition, actual cost of acquisition would be 5 lakh. 5 lakh or 8 lakh, obviously we are going to select whichever is higher. So 8 lakh would be exempt. If you observe something, I'll change the numbers over here. See, up till 8 lakh, that is the fair market value as on 31/1/2018, you will not charge even single rupee up till 8 lakh rupees for the taxable. Excess of 8 lakh only will be your taxable amount. Let's, okay. So what is it going to be? 8 lakh means it is going to be another 8 lakh, that is difference of this and this will be taxable. Clear? See here, let's change this number, okay. Let's change this number just to keep it some difference. 9 lakh rupees will change it as. So here in this case, it is going to be your 9 lakh only. Just an example. I have changed it as 9 lakh and I have closed. Okay. So higher of the following, actual cost of acquisition, lower of the following, this would be the point or this would be the consideration. So now what you would do is that higher of the following, that is actual cost of acquisition, lower of the following, this would have been considered. Now, please try to understand one point over here. What is the actual cost of acquisition, people? 5 lakh. Here it is 9 lakh. In my example, up till the fair market value, it is not going to be taxable. We'll try with the different numbers. Okay. See here. We'll change the cost of acquisition to 7 lakh now. 7 lakh rupees is my cost of acquisition. Now tell me, 9 lakh or 7 lakh, whichever is higher. Up to 9 lakh, I'm not going to make it as taxable. Next, I've changed it to 8 lakh. 8 lakh or 9 lakh, whichever is higher, not going to make it as taxable. If my actual cost of acquisition is 10 lakh, if my actual cost which is incurred is only out of my pocket, what has moved is 10 lakh. I'm going to consider whichever is higher. This 9 lakh rupees is the minimum based till second point. If it is higher, if my actual cost involved is more than the fair market value, I'm going to consider 10 lakh over here. Everyone, see now, let's change the example. Let's consider this is going to be 8 lakh only. Okay, this is going to be 8 lakh. Now, let's change the sale consideration now. Okay, sale consideration which is being changed to 10 lakh here. How much is my sale consideration? 10 lakh. I've told you up till this amount, this is the minimum amount at which I'm not going to pay any capital gain. Higher of that, I'm going to pay. That is, difference of this amount is resulting in 1 lakh. I'm going to take 1 lakh. Clear? Next, difference of these two. After this, let's consider the fair market value is going to be so much and sale consideration is going to be so much. Let's consider your actual cost of acquisition now is not 8 lakh, now it is 11 lakh. People, if it is 11 lakh, your sale, whatever you're doing is 10 lakh. Out of that, money which moved out of your pocket is 11 lakh. Yeah, it means you have paid more than the fair market value as on 31/1/2018. This is the only situation which can result in a loss from your capital gain under section 112. Remember, if your actual cost of acquisition is higher than the sale consideration, not FMB greater than sale consideration. Actual cost of acquisition being more than sale consideration. This is the only situation that is going to result in loss. See here, your actual sale of consideration is 10 lakh. Let's take an example. Let's change the number. This number would be somewhere around 7 lakh. And your fair market value is going to be, let's consider 12 lakh. Okay. If you would have sold on 31/1/2018, your what would be the fair market value that you're going to consider? 12 lakh. Lower of the following is what you would consider, no? So the maximum that you would take, that you would get selected under your option number 2 would have been 10 lakh only. It would not have been your 12 lakh. Lower of the following, even though if it is 22 lakh also, you would select the sale consideration only. That is lower of the following. So whatever might be the answer that you will get in fair market value, even 10 crores also, you can never get a loss just because your fair market value is higher than your sale consideration. It is going to be nil position. You're not going to pay tax. But loss can occur only if your actual cost of acquisition is higher than your whatever the fair market value is of your considerations. Clear, everyone? I hope it is clear. Okay. See. And remember the taxability of your long-term capital gain that is coming under section 112A is going to be your long-term capital gain 112A is going to be 10% in excess of 1 lakh. Suppose your long-term capital gain is 5 lakh, that is under section 112A. 5 lakh minus 1 lakh, 4 lakh rupees is the point. 4 lakh rupees multiplied by 10% would be your long-term capital gain that you would get. Clear? That would be your long-term capital gain that you would actually get. Clear? This is going to be a long-term capital asset under section 112A. Simple. Now, when it comes to your financial asset now has two things: bonus shares and right shares. Okay. People try to understand the point of the bonus shares which is coming over here. The bonus shares, they try to understand the bonus shares which is coming over here. Okay. Now, when it comes to your bonus shares, people, remember, allotted, if the bonus shares have been allotted, what are bonus shares? The shares which are giving to the existing shareholders without taking any money, without receiving any money. That is, actual receipt of money is not there from the shareholder. That is, the company is going to convert its key reserves, convert its reserves into the shares, that is into the share capital. Bonus shares, ideally speaking, I being a shareholder, I will not even pay single rupee as my cost. That is as my cost to buy the bonus shares. It is just given by the company side by themselves. If the bonus shares are allotted before 1/4/2001, remember the cost of acquisition for that fair market, that is for those bonus shares, would be fair market value as on 1/4/2001. If it is allotted on or after 1/4/2001, the cost of acquisition would be nil. Now, when it comes to the long-term capital, that is long-term capital assets of the bonus shares, we've already seen long-term capital assets of the normal shares, that is coming under 112. The cost of acquisition would be determined in this manner. Similarly, the cost of acquisition also would be determined in a similar manner for bonus shares. Try to understand. If it is considered as long-term, the cost of acquisition would be the actual cost of acquisition. This would be nil. If in case the cost of acquisition would be nil, if it is allotted on or after 1/4/2001, and it would be fair market value on this date. Actual cost of acquisition would be considered this if it is allotted before 1/4/2001. And lower off would be the fair market value as on 31/1/2018 and the actual sale considerations over here. Lower of the following would be considered. Whatever we have discussed over here, the same point would be coming into picture. So this calculation you would do similar to this calculation, but the cost of acquisition over here would be determined if that bonus shares have been issued on this day, you would consider the fair market value for determination of actual cost of acquisition. If not, you would consider it as nil. Here, this is about the bonus shares. Now, when it comes to right shares, remember, right shares are something which is given at a discounted price basically. If the market price is 100, suppose, if they are issuing it at 80 rupees, right shares, then what would be your advantage, people? Market price is 100, but the company is issuing shares at 80 rupees for existing shareholders. If you accept it, three things can be done in the right shares in case of me being a shareholder. I can either accept it, that is right shares, I can accept it. I can reject it on their face stating that I don't want the shares at all. Third, what I can do is that I can renounce it. Renunciation is possible. Everyone, renunciation is possible. Accept it means, okay, I'm going to buy the shares. My cost of acquisition would be, in this case, my cost of acquisition would be how much? 80, because I'm buying it at 80. If I'm rejecting on the face, I'm telling that hey, I don't want the shares at all. I'm rejecting. So it is that. Renunciation means I being a shareholder, company is offering me shares at the price of 80. What I'm doing, I'm offering it to someone else, to my friend or relative, whosoever it might be. I'm offering it to them, stating that, Array, do one thing. The shares are being issued at 80. I don't want to buy it. Do one thing. You buy the shares at 80. Okay. So now here, this fellow, Mr. B, will buy it at 80, will give 80 rupees directly to the company. Okay. Shareholder transferring the value, transferring the right of buying the shares at a lesser price is called here renunciation. Now, Mr. This shareholder, me being a shareholder, if I'm giving to Mr. B at the price of 80, I'm not going to give it at free of cost. I'm going to charge something called as value of right. Okay. Now, Mr. B gives 5 rupees for me for one share and gives 80 rupees for the company. Tell me, for the shareholder and for Mr. B, how much would be the cost of acquisition? People, for shareholder, if you understand something, this fellow is not giving anything. I told you, cost means something which is moving out of your pocket, is not giving anything, people. So the cost of acquisition would be nil. Mr. B, on the other hand, this fellow is paying 80 plus 5. It is going to be 85, which is given to the company. So cost of acquisition for Mr. B would be 85. Clear? This is the concept of right shares. Now, in case of any other capital asset brought into picture, remember the cost of acquisition for any other capital asset other than goodwill, right shares, bonus shares, and whatever 112A, whatever we have seen, it is going to be your cost of acquisition or the fair market value as on 1/4/2001, whichever is optional of assessing. People, this is option. Okay. If you bought the capital asset before 1/4/2001, then your cost of acquisition would be determined as actual cost of acquisition of fair market value as on 1/4/2001, whichever is optional. People, if they're stating it as optional over here, can I say one thing? If the cost is 10 lakh rupees in this case and the fair market value is 12 lakh, you only tell here what you're going to consider as your cost of acquisition. You're going to select 12 lakh only, no? Because I've already told you, higher the cost of acquisition, lower the capital gain you're going to get, lower the capital gain, lower the tax. So you're going to select 12 lakh. What happened was, in this case of you considering fair market value, people started taking advantage of stating the money, like whatever the higher price they wanted to. So the department thought, okay, we'll do one thing. Only in case of land, building, or both, we are going to have the point called as stamp duty value. That is the price of that value of that market is going to be there with the government. Stamp duty value is the data which is there with the government with regarding to the price of the land or building or both. Whatever the stamp duty value as in 1/4/2001 or fair market value as in 1/4/2001, you have to consider whichever is lower. Whichever is lower, whatever the answer you are getting, you are going to consider that whichever is lower point over here in your second point. This or this, now you are going to make. In case of land, building, or both, this becomes your step number 1 and this becomes your step number 2. Simple. In case of other than land or building, people, this point will not be applicable in case of other than land, building, or both. Simple. You're going to directly apply the second point and you're going to close. And in case where the property has been acquired from the previous owner, cost of acquisition acquired from the previous owner cannot be ascertained means you are the person who's selling the property in PY 2024. Okay. So In PY 23-24, you're selling the property. You have got this property because of the property being transferred in your name from your parents in PY 18-19. Suppose. Okay. In PY 18-19, your parents have transferred that land in your name. You are selling that in 23-24. Your parents have purchased that in 2003 and 4. Suppose. Okay. The cost of acquisition, remember, in this situation as of now, whatever is the cost of acquisition your parents have incurred, that is the previous owner had incurred, that will be your cost. Because ideally, think people, the property got transferred in your name by your parents. Your parents wouldn't collect any money from you, no. So your actual money moving out of your pocket is nil. But your parents are transferring you the property. Your parents have incurred the cost. So previous owner, whosoever has incurred the cost, that fellow will be the person who will be incurring the cost of acquisition. Clear? The cost of your previous owner becomes your cost. The period of holding, people, period of holding means for the purpose of indexation, you're going to consider the denominator year of purchase. No, that year of purchase starts from the year of purchase of your previous owner. That is from your parents in my example. Okay. Previous owner, whatever is the cost, that is going to be considered as your cost. The year of purchase will be the year from which your parents have purchased. Okay. Now, if the cost of acquisition of your parents doesn't know what cost they have incurred for this property. Okay. So in that situation, what you will do is very simple. Fair market value as on the date when which is capital account became the property of the previous owner. When your parents have purchased, what would be the cost of acquisition? That would be considered as your cost of acquisition here. Simple. This is about your cost of acquisition. Now try to understand one thing. Point being of cost of improvement, very simple. People remember cost of improvement, what happens is whatever is your cost of improvement which have been incurred, you have incurred, your previous owner have incurred, whosoever it might be, before 1/4/2000, before 1/4/2001, if you have incurred cost of improvement. Cost of improvement means you have purchased the land and building of first floor. You have added, that is, you have incurred the cost for construction of second floor. The cost of improvement should increase the value of that property. Okay. If it is, if this cost of improvement has been done before 1/4/2001, it is going to be considered, the cost of improvement will be considered as nil, remember. Okay. If it is incurred before, it is nil. If it is incurred on or after 1/4/2001, it is going to be your cost of improvement would be considered as the, whatever is your cost of improvement, that would be considered as your COI. And you would get the indexation benefit depending on whether it is long term and short term as usual. Clear? Understood? So this would be the